Hey everyone, what if I told you there's a single number out there that can act like a thermometer for the market's mood? A number that tells us if investors are feeling confident or if they're running scared.
Before we dive in, just a quick heads up, pause the video now and take a moment to read the disclaimer.
Just think about that for a minute. The market can feel so chaotic, right? It's this whirlwind of headlines, emotions, panic, and hype. But what if you could cut through all that noise and get a simple, clear reading on how everyone is really feeling? Well, that number actually exists. It's called the gold-silver ratio, and it's a surprisingly powerful tool for gauging market emotion. You can think of it like a barometer. You know how they measure air pressure to predict a storm? This ratio measures investor pressure to give us a clue about what might be on the horizon. So, first up, let's break down how this emotional barometer actually works. The formula itself, it's incredibly simple. Seriously, you just take the current price of 1 ounce of gold and divide it by the price of 1 ounce of silver. That's it. The number you get is the ratio, and what it's really telling you is how many ounces of silver it takes to buy 1 single ounce of gold. Let's use an easy example. Say gold is trading at $2,000 an ounce and silver's at 25 bucks. You just divide 2,000 by 25 and you get 80, so the ratio is 80. That just means you need 80 ounces of silver to trade for 1 ounce of gold. Simple, right? But the real magic is in what that number is telling us. Okay, so what does a number like 80 actually mean? Let's decode this thing and understand the tug-of-war it represents between fear and confidence. It all boils down to this. When the ratio is high, let's say over 80, it's signaling fear. Investors are in a risk-off mood. They're nervous, so they're piling into gold for its reputation as a safe haven. On the flip side, when the ratio is low, like below 60, it signals confidence. Silver is a huge industrial metal, used in everything from solar panels to electronics. So when the economy is booming, demand for silver goes up and the ratio drops. That's a risk-on environment. And hey, this isn't just some abstract theory. History shows us that this ratio consistently spikes like a fever during major crises. I mean, think back to the 2008 financial crisis. The whole system was on the edge of collapse. And what happened? Investors panicked, and they stampeded into gold for safety. Unsurprisingly, the gold-silver ratio shot way up, climbing well above 80. It was a crystal-clear signal of extreme fear. And we saw an even crazier spike in 2020 with the pandemic. As the entire world was shutting down, the ratio just rocketed to an all-time high of over 120. That number reflected pure, unprecedented global panic. All right, so understanding the signal is one thing, but how can we actually turn this into a strategy? Let's move from just theory to actual practice. And the best part is, you can track this yourself, totally for free. Just pull up a charting platform like TradingView, go to the symbol search, and type in XAUUSD/XAGUSD. That's just the ticker for gold divided by the ticker for silver. Hit enter, and boom. You've got the live gold-silver ratio chart right there on your screen. So what do traders do with this chart? Well, there are a few ways to play it. Probably the most popular strategy is called mean reversion. The logic is simple. When the ratio gets to a crazy high extreme, it's probably going to come back down to its average eventually. So traders will bet on that by selling gold and buying silver. Of course, others might follow the trend or use the ratio as one piece of a much bigger macro strategy. Let's look at a concrete example of that mean reversion idea. Here's a very simple strategy that was backtested. The rule is you enter a trade, selling gold, buying silver, whenever the ratio hits 90 or goes higher. Then you just hold on until the ratio falls back below 75, which signals things are getting back to normal. And the results? They're pretty stunning. Between 2019 and 2024, this simple rule only triggered 2 trades. But just look at those profits. Now here's the crucial part, so don't get carried away. These opportunities are rare, and if you look at the dates, you'll see you had to hold these positions for over a year, so patience is absolutely essential. So where does that leave us? Let's take one last temperature check of the market using our little barometer here. In early 2025, the ratio was sitting right around 100. Now, based on everything we've just discussed, that number is a pretty clear warning sign. It's firmly in that high fear territory, which suggests there's a lot of economic stress and anxiety out there among investors. Look, at the end of the day, the gold-silver ratio isn't a crystal ball. It's not going to predict the future. But it is an incredibly valuable temperature gauge. It's an early warning system that lets you know when the market climate might be about to change. It's a fantastic tool to have in your toolkit. The only question now is, with the thermometer reading this high, what happens next?
Hey, if you found this explainer helpful, please do us a favor and hit that like button. And make sure you're subscribed to our channel for more content like this. Thanks for watching.